All right, I think we have about 30 people here in the room, so we can go ahead and start. Very good afternoon, everyone from Singapore. A warm welcome to you all, and thank you for being with us today. I'm Kristen, and I'll be your host for today. So I lead the platform syndications team here at Funnel. And a little bit of background on me, I started my career in investment banking in New York in energy and natural resources before moving back to Singapore, where I'm from, to help build out a biotech startup in the region. And I joined Funnel as Director of Investments just over 2 years ago. So if you're not acquainted with us yet, Funnel is Southeast Asia's largest private investments platform. And we leverage technology and data to curate opportunities in growth at pre-IPO companies for a global network of over 13,000 investors. So before we kick things off, just some housekeeping matters first. Later on, we'll set aside about 20 minutes for Q&A, and you can put in your questions via the Q&A function at the bottom bar on your Zoom app. So feel free to send us your questions at any point during the event before you forget, and we'll kind of get around to them later during the Q&A portion after the panel discussion. So we'll also be recording this session. So if you have to miss any part of it, not to worry, you'll be able to access a recording after this on our blog. And the URL is blog.funnel.com. And we'll also paste a link in the chat box down below as well. Okay, so today I'm really excited to be hosting this webinar. And I'm sure I'll provide some insights into one of the most important, often vexing questions that startup founders face, which is fundraising. So more often than not, the first thing that comes to mind at the very mention of startup financing for startups is equity, right? News of startups raising equity from renowned VCs, achieving decacorn or unicorn statuses. These tend to dominate the headlines of online tech publications, and news, but comparatively little is said about what is often perceived to be the less flashy, less sexy, more down-to-earth cousin of equity, which is debt. So first things first, what is venture debt? So venture debt has a fairly broad definition, and it covers a variety of lending, including asset-based loans, convertible notes, term loans, or even revenue-based financing. And it may also include features such as warrants or the right to purchase equity to compensate for the higher risk of loan defaults. So in Southeast Asia, venture debt is still a relatively young asset class, but it is steadily gaining recognition. According to a report by PwC in 2020, venture debt made up about 10% of overall venture funding volumes in the region, compared with 19% in the US, which is about double. So in February this year, in Singapore specifically, the government has extended and enhanced its enterprise financing scheme, venture debt program, to support the growth of later stage enterprises. And it raised the maximum loan quantum from about 5 mil to 8 mil. So as you can see, venture debt is definitely gaining relevance in the region. And in today's panel discussion, we'll discuss how startups and founders can strike a balance, how companies can arrive at a balance between debt and equity raises, how founders can raise financing while thinking about maintaining a healthy cash flow. And we'll also look into the future a little bit. So we'll look into the crystal ball a little bit and get our panelists' insights into how the debt financing landscape will continue to evolve. Before we dive in, I'd like to first welcome and introduce our speakers today. And I'm very grateful to have with us a really diverse panel of speakers who occupy very different parts of the startup ecosystem. So they're all deeply involved in their own ways, and I think that they each bring very different perspectives to the topic at hand. So we have Giulianna, the head of ventures at Draper Startup House, where she heads the venture program and helps to give startups access to over 500 global venture funds, in addition to managing the Draper Startup House Ventures Fund. We have Mahesh. He's a founder and chief executive officer of 20 Cube Logistics, a new age logistics company created to make trade easy and digitalize the supply chain. And last but certainly not least, we have Zhiyi, who spearheads the business development team at Lyte Finance. Lyte Finance is a fully owned subsidiary of Lyte Ventures, which provides B2B financing to companies in Southeast Asia. So thank you all for being here today. We really appreciate your time. And let's dive right into our panel discussion today. So let's first talk about the state of play when it comes to debt. And I also invite the speakers to introduce yourselves to our audience here as well. So let's start with Giulianna. So Giulianna, in your role with Draper Startup House, what are you seeing in the financing ecosystem with the startups in the DSH family? And are a lot of them exploring debt as a financing option?
Hi, everyone. Thanks, Kristen, for having me, as well as the Fundnel team. I'm normally based in Singapore, but today I'm calling in from San Diego, California, where I'm just kind of hiding out until, COVID gets a little bit better, most specifically the quarantining. But I think in the financing ecosystem, mostly I deal with very early stage startups. So Draper Startup House, first and foremost, is started as a concept of entrepreneurial hospitality. And what that looks like, it quickly became epicenters in all of the locations that we were currently found ourselves in the ecosystems. So our first location was on Siang Hill on Club Street in Singapore. And then we quickly branched out, and now we're in 14 global locations, including Europe, mostly Southeast Asia, North America, and we're now beginning Latin America. So what started as entrepreneurial hospitality, we quickly realized that a lot of really great founders and startups were coming through these doors from multiple different ends of the spectrum. Anyone who was ideation stage to raising a Series B or C, and from every corner of the world. So we started as a company called Tribe Theory, but in 2019, early 2020, we rebranded Draper Startup House as we also raised our seed round from Tim Draper out of Silicon Valley in San Mateo, California. So once we sort of took that deal, we had access to the 30 global Draper funds, very local ones in Singapore, like Wavemaker, and then Draper Associates, and a lot of other ones all over. So we quickly became a sort of a matchmaker for deals. And we could set up a very simple MVP in March of 2020. And what that looked like was we essentially, wanted to match deals to our awesome investor partners. I mean, we had a lot of great founders that we knew very well and personally. And like I said, these were anyone from CPG companies to, SaaS to, a lot of just everything that you could think of. And at that time, now we're currently launching our first micro fund about next week. So really exciting time for us and really exciting for all the founders. I think I saw a few names that, I personally know as well. So awesome to see you guys here as well. So what are we seeing in the ecosystem? Are they exploring debt as a financing option? I think, again, COVID sort of, flipped the rules in a lot of scenarios, and especially at a time when I was helping entrepreneurs and founders find access to capital. I don't think debt was anywhere near a lot of their minds. And, I think there's been a lot of progress made on financing and fundraising in general from, a lot of the Reg CFs and, the US, and it looks different every single pocket of the world. I think for the most part, most of them aren't considering debt. I don't think that a lot of the early stage founders as well, like, Kristen said, they're mostly focused on equity financing as well. I think for the most part, they don't consider debt. A lot of them that are MVP stage also are looking sort of for that F&F round or an early angel round to sort of get their product off the ground and sort of test in the markets that they're in. So I think for the most part, it varies in all of the different regions. A Series A in Asia is, a seed round in the US, and it looks different in every single ecosystem. But I think for the most part, a lot of people don't also know sort of the areas that they're able to tap into. Like Kristen said, debt is sort of, not something that a lot of startups I know personally looked into until COVID, when they were having trouble, finishing their raise, and they sort of tackled it alongside, maybe a partially filled equity round, so that there were ways for them to finish financing and get to where they needed to be. But a lot of people I noticed, and founders, sort of went the other way and decided to not fundraise and to pivot really hard and to get any revenue they could to sort of keep the doors open until they could fill a larger equity round also. So that's currently what I'm seeing in a nutshell. I'm sure that Zhiyi and Mahesh have, much different opinions in what they've seen as well. But I think, like I said, every ecosystem is different. I think COVID affected everybody differently, but for the most part, what I'm still seeing at the early stage, I'd say 65% of the companies that we see are raising anywhere from 100K to $1 million. And along those lines, we're still pretty focused on, safe notes, convertibles, and sort of the equity spots in general.
Got it. Got it. Great. Thanks for sharing, Giulianna. Okay, so on that note, let's kind of shed some light on some of the options, shall we? So maybe you can turn to Zhiyi. And yeah, Lyte Ventures was one of the first movers in the early to growth stage lending space. So I think it's a really interesting story, really keen for you to share how Lyte came about and what kind of choices and decisions Lyte has made along the way, right, in terms of who it lends to, what kind of debt it lends out as well. And of course, please introduce yourself too while you're at it.
Thanks so much, Christine. Thanks for being here. So unlike Giulianna, I'm not in the US. I'm actually in Singapore. So a little bit of background about me. I head the Lyte Finance team in Lyte Ventures. So Lyte Finance is a subsidiary of Lyte Ventures. So we have two operating arms. We have one, which is Lyte Pay. What Lyte Pay does is we do advancements for freelancers. So if you have, some future earnings that you're waiting to collect, we help you advance that such that you can get that today, right? And then for Lyte Finance, we are a business-to-business lending house. We started out doing factoring, and then we expanded to just the traditional term loans and including bullet repayments. So the kind of clients that we speak to, it's a large range. So we go from Series B all the way to Series E. So if you have any working capital needs, happy to help. I guess how a lot of you might have the question, like how we're quite different from a lot of the other players out there. So I guess three differentiating factors. So the first one is we turn around quite quickly. In terms of, then the second one would be flexibility, right? So what I mean by flexibility is that if you look at traditional banking, is really I have a product, take it, right? And it's the same that applies to everyone. How we do it quite differently is we spend a lot of time with the entrepreneurs, the founders, to really understand what their business flows are. And then how we do it differently is we actually plug ourselves and our products in there, in the different milestones of that business, right? And the last point is that we are able to do bigger amounts, right? So on average, we do about like 3, but we can do up to 10, right, at one go. To also share how we kind of came about, it's quite an interesting story. So one of our founders, Vincent, he actually had this thought, right? So if the future, or if we believe that in time to come, more and more talents that will power businesses will be freelancers and contractors. So we'll love to work with them, right? So we can see how businesses can better take care of their talents. So with that, and he thought about it and he was like, okay, by the way, he's a father of 3, right? So if his son were to be a freelancer, how does his son feel assured, right? Which is also our mission, to create an assured future for all. How does he feel assured, and how does Vincent as a father feel assured that, hey, my son is a freelancer, but I know that he can take care of himself financially. If you look around us today, the banks don't have that infrastructure to support that yet, because it's kind of blurred, right, that line. And the banks would see you, a freelancer, as an individual who's taking on an individual personal loan, right? And of course with regulations, that's quite difficult today in today's environment, right? So yeah, this is how we came about and how we wanted to support the freelancers, and also of course the businesses fit into the ecosystem, because businesses are the biggest paymasters of these freelancers, right? And I guess more technically, like you have already mentioned earlier with regards to venture debt, like really just the boring technical narrative, it's actually a form of financing, right? Which is more well suited for high growth startups that do not have collateral. So if you notice, if you go to the bank, they usually ask if you have certain collaterals. For a young startup, I think that is usually impossible, right? It's usually quite difficult. And the difference is, on top of the monthly interest that you have to repay, they also take warrants, or also the right to purchase equity at the end, right? That is to compensate for the higher risk of the loan. Now, for straight lending, it's really just, I give you a loan every month, you give me a monthly repayment, right? And I earn the interest for the risk that I take. I do want to share why we are sticking to the more traditional lending route, right, which is that straight lending. So we spoke to a couple of entrepreneurs, and they have expressed that they'll be more motivated if they were to be able to keep a larger share of that company. And of course, with our mission to create an assured future for all, we did ask ourselves this question, right? So if it were me, what would I want? And then we realized that, okay, I think the answer is clear enough that we shouldn't be taking a percentage of their company. We can also help them by just giving them a loan while they repay the interest over time, right? So that's how we came about choosing that structure for our business. I hope that answers your question, Kristen.
Yes, it does. It does, absolutely. Cool. So I think based on what Giulianna has mentioned, what Zhiyi has talked about, clearly there are, certain criteria, right, in place. Like, it doesn't make sense that you have an idea, you can borrow a bunch of money and kind of mortgage, your house and everything to do that, right? So clearly, I think venture debt and debt, it would suit a certain type of company, and it's definitely not a one size fits all, right? Like within venture debt itself, there are so many configurations, so many options, and I think definitely important to find a lender that will work with you, kind of have that flexibility, like Zhiyi mentioned, Lyte has, to really figure out something that works for the company as well, right? Okay, so turning to Mahesh. So from an entrepreneur's perspective, right, you've kind of gone out and ventured into the great unknown as a startup founder. So how do you view the financing environment today, specifically the lending space?
Okay, thanks, Christine. Thanks, everybody. So to give you a background, I had a successful corporate life for several years, and about 8 years back, I first generation entrepreneur, wanted to get the treasure hunt in the digital space. So my domain knowledge is in logistics, access in Asia. So I embarked on the digital space, in the logistics space, but hunting the digital treasure. So we are now about 8 years in the journey. So we started from ground zero. So now next month, we'll be filing our prospectus for a listing in the ASX stock exchange. So we're now $150 million revenue, about 13 million in EBITDA. So everything about entrepreneur can go through from the concept note to IPO. I think I can write a book on that. The venture debt, but the first hurdle that you have to cross is the seed capital. Because when you get into the entrepreneurial journey, you assume a lot of scenarios that fundraising is XYZ. But only when you get in there, you realize that you knew not even 5% of what it really is. So you have already made your plans, you're already in water, and then you will have to find a way to swim because you have no choice because you're already in it. But if you believe in your project with conviction, you can work through all these, because borrowing in Asia is there is more for borrowing in Asia than what is on paper and what is on numbers. It's more a trust and a credibility ecosystem to sail through short-term financial ups and downs is different. The West is different. Of course, we got to realize that I would be brutal here. Banks don't know to lend. I mean, they just talk about lending, but they really don't know to lend. The logic doesn't work because if you look at the bad debt history on the debt markets, the microfinancing and early stage company bad debts percentages are far below than the high ticket size debt exposures as Asia as a whole. And money goes where money already is or perceived to be is, and that's how that high bad debt ratio comes. This is Asia as a whole, if you look at. So seed capital, yeah, getting into a venture equity stage, and then even matching early stages, you really have to match your capital structure at least 1:2, because venture debt is very expensive. So we will have to go for creative debt structures, where it's either cash flow based. Once you cross the seed capital stage and you run your journey with a nice record of your cash flow management system, your business itself very narrowly focused, and then getting into your Series A equity, it's a little easier to your seed capital. But once you get your Series A, the debt, the risk, the challenge of securing the debt becomes a little easy. But still it is difficult. It's relatively easier. But even as your business goes, because you are an ambitious entrepreneur, you end up over trading all the time. You will violate all fundamentals of your financial management principles, what to use equity for, what to use debt for. We all studied in our MBAs or in the universities, but you are in water, you will mix up all the time. So that is where you need, even on a mid-sized company, even now when we are a $150 million company, we do have requirements for short-term 2 million funding, 3 million funding, $500,000 funding, because the external world is not as it used to be a decade ago. It's so dynamic, and entrepreneurs always want to exploit those opportunities. So debt is a very important area. The venture debt and non-collateral based debt is an art in Asia, and that's a big market for companies of your nature. And yes, I think we should go out of the box. That will help the upcoming entrepreneurs a lot. At the same time, my personal view is that's a less risky space than large institutional lending.
Great. Thanks for sharing those lessons and pearls of wisdom, Mahesh. I would definitely read the book, even when you do write one. Yeah, so maybe that's a good segue to turn the.
But if there are young entrepreneurs in this group listening, I can tell you that you will reach a stage where your friends and relatives will run away when they see you. But that's the joy of building an organization. So.
Yeah, with conviction, right? That's important.
You should believe in what you want to build. You should believe. I think as long as that is rock solid, everything else will fall in place. Yes, you will. It won't come and land on your table, but you got to go in search of it. It's a challenge, but you can work through those.
Great, great. Yeah, so that's probably a good segue to turn the time to Zhiyi then. So you've worked in a bank, you've lent out of a bank. So, today at Lyte, you're looking at a very different set of borrowers, very different set of criteria. What do you guys look at when you're evaluating potential borrowers? And I think obviously lending to startups is risky, right? There is some amount of risk involved there. So how does Lyte kind of manage that risk of lending to these, growth stage companies?
Okay, so I have to say that it isn't rocket science. So I would like to start with like a little exercise that you might imagine, right? So imagine if your friend comes to you to borrow, say, 100,000 over 12 months. Like, how might you evaluate your friend, right? So I think the first question you might ask is about the purpose. So like, what do you want to do with the money, right? And then the second question would be related to the repayments. So for example, does my friend have a job, right? Is she good at her job? What if she loses her job, right? Then you might go on to ask, because you might wonder how you're going to get paid back, right? So how much is her salary today? What will her salary look like in 12 months? And is she going to get promoted, right? Because all these things will come into the repayment that will make you feel a little bit more comfortable. The third point would be the debt situation. So for example, does my friend have an existing housing loan? Does my friend has an existing car loan? Will she be able to repay me on top of all the other additional obligations that she has today? Then the last point would be the environment. So if we look at COVID today, right? So you might wonder, how would COVID impact someone's job, right? Will my friend still have a job in 6 months? And is she good at her job, right? These are all important factors. But coming back to the business, what is really important for us is to get to know you a lot more. So it's not entirely about the numbers, right? But it's also for you to share your vision and also where you plan to take the company in the future, right? So I think a lot of the times people just share what they think or what we ask, but I think it's, some people tend to ramble on, and that's what's good, right? Because we tend to understand what's the history, how you got started. So for example, like Mahesh will say, oh, I used to work in this other logistics company, right? So that would help us a lot with the analysis process. Sharing our plans is very important, right? So it's not about your background as a founder, but it's also why you're doing well, right? So if you expect yourself to do better, then tell us why, right? So for example, I have X number of contracts, right? And if you're not doing well, that's also okay. It's understandable that in an unprecedented time like COVID, some businesses, for example, the airline industry, hospitality, tourism, tend not to do as well. But that's fine. You just have to share why you're not doing well. What does that future look like, right? Because it may just be this period of time where you're not doing well, but if you have all these contracts gathered, then to us, we are more assured that, hey, like the company is going to continue on in the near future, right? So that what does that future revenue look like? If you've been through a tough year and have emerged stronger, how do you manage that, right? Because what we want to know is how did you sail the company through this tough time? So these are helpful tools to help us evaluate how you might respond to different events. If I were to talk a bit more about the banks, right, and how they evaluate a process, they are very much focused on the numbers, which sometimes could be backward looking. Right? So for a company like, if I were to use Singapore Airlines as an example, Singapore Airlines probably did quite well in 2018 and 2019. If you look at 2020, might feel like what's going on, right? So I think that's not a accurate representation. Banks also look at taking collaterals, right? So for example, do you have a property? Are you going to give me fixed deposits? Do you have any charge that I can take, right? But what we place emphasis on is the future of the company. So more forward-looking indicators. For example, if you have live data, we would like to work with it. So if you were, say, a F&B outlet, you're a new F&B outlet, you opened last month, sales is probably minimum. Right? But who knows, maybe Mothership posted you on their platform, and then you started to see a lot of traction. If you have live cost data that you can feed to us, we can immediately see the growth in the revenue, right? Which at that point, we'll be happy to help. So that's how we evaluate overall. So I know it's countless of things that we look at. So it's not only the soft factors, but it's also the financial data. We just look at it in a holistic way, and then we make a decision.
Great, thanks for sharing. And I love the analogy as well. I think that's a really intuitive kind of way of thinking about it, right? It really also captures what institutional lenders and what professional lenders are looking at when they kind of evaluate the startups too. So yeah, I think those are
not rocket science. We do that all the time. I mean, people, I'm sure everybody has a friend who has tried to borrow money from them.
Yeah, I'm sure that's not uncommon. Yeah. Okay, cool. So Giulianna, turning the floor back to you. So from your experience, how have you seen these early stage companies that you work with navigate the conversations with investors around revenue growth, cash flow? I think Zhiyi made some great points there about, you have to kind of tell me your story. You have to be kind of transparent, right, about where you have been, the lessons and the challenges that you're facing, and where you're going from there, right? So Are there regional differences that you observed as well, say in Asia versus in Europe or the US? Yeah, would love to hear your thoughts on that.
Yeah, I think, it's interesting to hear how G sort of, looks at, and sort of analyzes those different deals. I think, on the debt versus, equity side, there are definitely different scopes to look through it. I think the first two questions, like you just asked me, like, how do you differentiate between revenue growth and, cash flow? And I think two of our first questions are, do you have runway? Do you have any money? Because a lot of times, these founders have never raised capital. A lot of them are technical founders and they've had a product, and that's why they are fundraising, is because now they're at a point where they think that, the growth capital can help accelerate their business. Revenue, I mean, that comes in pre-rev and post-rev. And I think for the most part, it sort of depends on the product phase. Some of the founders that we see are also raising capital in order to finish their product or sort of get to the next iteration and or build a really quick MVP and sort of test to sort of see if that they should raise, actual capital. Maybe that's when they consider debt. And the founders that are a little bit further along, I think, that kind of comes twofold. And that's, I think, maybe, not necessarily a conversation of cash flow, but it's more so revenue. And if it is revenue, I think it's either revenue and or growth, because I still think at this point in time, especially for those geographies that are, really looking at growth, capital, and those that are, really understand, risk capital in general, are sort of seen inherently whether or not, if they aren't generating revenue, what's their growth, what's their user base. And I think that's the balance. I think at the earlier stage companies is, if they don't have, hundreds of thousands of dollars in ARR, or, what they're trying to figure out, well, then what percent of, their user base and or community and or people who are using the app, if it's, a network generation sort of situation, in order to balance their lack of revenue or sort of their insufficient capital. And I think, like I said, there's been times when I've looked at startups and have been screening decks, and I'm like, personally, I don't get it, but they're making a lot of money, and I think that's sort of where that balance comes into play, or I really get the idea and I love the concept, but they're not making any money. So I think it really, depends on the founder and what they're working on. And I think in general geographies, I think, what that looks like is sort of what I mentioned earlier, and is sort of in relation to the understanding of risk capital. I think Southeast Asia, has obviously grown a lot and immensely in this category, especially in this current economic situation, which has been interesting because of COVID. But at the same time, there's still a lot of money out there, right? There's still a lot of funds, and there's still a lot of people closing funds, and there's a lot of people investing a lot of capital. You just have to know where to find it. But I think for those geographies that do understand risk capital and that are looking to take bets on the ed tech right now, or whatever's super trendy and whatever's growing, logistics, transportation, a lot of these really hot sectors, telehealth, all of these sort of sectors, I think, that's sort of where the risk calculation and capital calculations come into play also. In 10 years, what does this industry look like? In 20 years, what does this look like? In terms of fintech, what's the user adoption? And I think that's sort of all of the things that come into play. At Draper Startup House specifically, because we are in so many geographies, the European landscape is interesting because they take a lot of public money, and I think a lot of people, it's really a little difficult to raise seed capital, but it's really easy to raise Series A and Series B because now everybody wants to be in it. So I think their risk appetite is a little bit slower. But Southeast Asia is actually somewhere in between, and Latin America is also a really interesting geography because, the governments over there, especially now with their inflationary status and situations, is, now they're really throwing in risk capital, right? Because at this point, they're a really big push to crypto and blockchain because, they can't trust their currency, and they can't trust their capital, and they can't trust their governments. And so I think all of these have a different play. And I think in the United States, I think the US has always sort of been, a big leader in risk. And I think because of that, not as much emphasis on revenue and cash flow. I think the higher understanding of risk, the lower necessity of cash. And I think sort of the lower understanding of risk, the higher necessity and more importance it is to be making capital or making money and bootstrapping more effectively and being smarter with your decisions rather than throwing spaghetti at the wall and seeing what sticks, more or less. So I think that's sort of how I see the different geographies coming into play. And like I said, so I think that balance act is growth and revenue, rather than just cash flow and monetary situations. Because I mean, at this point, we invest in people, and I think that's obviously the most important most important thing. Where G mentioned, like, who is your friend, and I think especially at Draper Startup House, where we know every single person who comes to our space. And I mean, the first thing I do when I receive a deck is, I call our country manager and I'm like, who is this person? Like, what are they working on? How long have they been in the space? What do you know about them more than just what they're working on? So I think that's sort of how I see the balancing act at this stage. And again, like I said, I'm seed to Series A, and Series A is depending on where you are in the world, but holistically, I think for the most part, just all encompassing. So that's I think my take.
Great, awesome. Very interesting to hear about, what's happening in different regions and all of these kind of geopolitical kind of considerations as well, right? That we're kind of reading from the news and how that all kind of flows down and affects the startup ecosystem as well. So yeah, thanks for that awesome insight. Okay, so we're actually coming to the final part of our panel discussion. I can't believe it. It feels like we've just started, really. So, before we end off, I want to ask our investor and our startup ecosystem kind of facilitator, how they see the landscape changing. But before that, maybe I'll turn the floor to Mahesh first. So what will be kind of your advice, right? Now that you've gone through this whole journey, swam in these deep oceans for the past 8 years, and now you're kind of, just before an IPO, which is fantastic. So what are some things that startups should look for before they borrow, right? At what point does it make sense for them to start kind of thinking about that piece?
Okay. Number one, there's nothing wrong in starting to borrow if you have access as early as possible. There's nothing wrong in it. Second one is early stages, and even once you are confident that your business is sound, don't stop looking at your cash flow plan at granular level. You have to be on top of it. Your AR cash cycles, AP cash requirements. There are AP who are friendly vendors, non-friendly debt holders. Be absolutely on top of it, number one. Number two. Number third advice is, if you have access to borrowing, look at what is the value for you and don't look at the cost of the debt. So there are two different ways of looking at it. If your business, you got into it because you want to build something, and don't haggle about a percentage 2 here, 3 there. Be sure of the value of the cash and not cost of the cash. That's very important, I would advise. These are good, provided you are on top of your cash cycle and cash flow plan.
Awesome. Thank you, Mahesh. Yeah, absolutely. And I think that really that also speaks to building relationship, right, with the lender. I think that trust, building up that kind of credit and credibility and credit history with them, right? I think that's super important. Yeah, great. Okay, so maybe I'll turn the floor to Zhiyi now. So since Lyte started, it's been a couple years. How have you seen the lending space change? And how do you think the space will continue to evolve, especially in the Singapore ecosystem?
A big question. I think the difference between, from when I left the banking sector, I find the space a lot less structured, right? With more emphasis being placed on the customer's business model. So it's not about what I have that you have to use, but it's really more about what you have and then how we can help you grow, right? In accordance to your business needs. And every business might be different, right? And I think lately there are also a lot of companies in Singapore that are providing revenue-based financing. where they give you a loan and the repayments are pegged to your revenue, right? So I guess, well, it would be very fitting in this environment like COVID, right? If you see your revenues being impacted, that repayment amount wouldn't be so high, and that gives you more cash flow to continue to maintain your business today, right? So I think this is one difference. What I think that the future would look like would be more, okay, this, I mean, sound a bit like very old fashioned, right? But if you know kampong lending, so it's really lending to your neighbors, like, so you stay in the same village, you know the people around, and you can kind of vouch for them, right? So I think that would be increasingly popular. So me vouching for you, Kristen, right? If you want to go get a loan. And I think loans will become more on demand, right? So maybe in the past, if you want to get a taxi, you go out and then you flag, right? You might have to wait for 5 to 10 minutes, who knows? But now you want to call Grab, just pick up your phone and then you're like, okay, I need to call a car, right? So lending is going to be more like that. Instead of having to wait, say a week, 2 weeks, or even 1 month, I believe that in the near future, it could take minutes, right? Just like Alibaba. And there will be a greater use of alternative data, which is my kampong lending point. And also nowadays people do look at phone metadata, so on and so forth. So there are going to be a lot more different variables to what it just is today, which will allow lenders to do things a lot faster and with greater confidence, because the model just became even more robust, because you're looking at the different factors, which today if you use a lot of cloud-based softwares, these inputs can be put in instantly, right? So therefore, the decision that comes out can be almost as instant as well.
Awesome. Yeah, I think that's a great point, right? More transparency, more data points, more ability to predict, and I guess more recourse as well, right? Like really kind of building off the whole idea of knowing where someone lives, as you might colloquially say, right? And so I think that would be a really interesting kind of trend going forward too. So yeah, thanks for those kind of spot on insights. Okay, so I guess to finish off, Giulianna, so how do you think the financing landscape is going to change for startups, you know, especially as we get into this sort of strange twilight zone, right? We're now like definitely not post-COVID, probably like a more COVID endemic, you know, kind of situation or paradigm. How do you think financing for startups is going to change going forward?
Great question. I wish I had some awesome analogy like Zhiyi has been pulling all night here. Should work on those in the future. But I think, you know, like I said, COVID's a weird time for everybody. And I think actually because of COVID, it's actually made fundraising a lot more accessible. And I think, you know, Draper Startup House is a really prime example of, you know, this started as an experiment to sort of see how it worked to help, you know, the founder in Yangon, for example, who's going through a military coup versus the founder in Manila, you know, to raise capital and funds in geographies that aren't their own. And, you know, maybe they've never done this before. I mean, these startups aren't going public in 150 million in revenue. That's also incredible. So cheers to you, Mahesh. And I think, you know, for the most part, I think there's been a lot. First of all, I think it's a lot easier to get meetings. I think the world is, you know, a lot smaller now more than ever, and 1-2-step connections away, as long as you're willing to put in the effort to, you know, get to know these investors and get to know them and, you know, really do your research on the firms and the funds. I think, you know, now you have a better chance in this environment than you ever did pre-COVID. So I think in that general sense, you know, it's very optimistic. I think other things that I'm seeing shift. One, I think, you know, the amounts to raise have, you know, gone up. There's a lot of high valuations in the market right now, but at the same time, there's still a lot of money. And, you know, a lot of these funds have capital to deploy, and they are looking to do that. And again, I think it's about, you know, really doing your research, finding them. And on the flip side, if you aren't having any great luck, maybe because your numbers aren't as great, or maybe you had to do a down round, or, you know, whatever the reason may be, or maybe it's your first time and you don't necessarily know what you're doing. I think the important thing is to, if you are not able to close a round, and I think maybe it's not necessarily, obviously you have to ask yourself why you're unable to, and then maybe it's a time to consider that, but also maybe it's an opportunity for you to really look and hone in on, your value offerings to the customer, whether it's B2B and or B2C, and actually start generating revenue in a way that you can. Instead of giving up maybe because you can't find a way to fundraise. And if you don't consider that a possibility, maybe you're working on the wrong thing. And I think crowdfunding and a lot of these platforms that were historically only for CPG companies and brands, and the Shark Tanks and the Meet the Drapers and all of these shows and opportunities. I think one, it's really easy to get your brand out there. It's a lot more easy for growth these days, even sans a marketing budget. I think there's a lot of good ways to get your product out there and your name out there. I think there's a lot of ways you can strategically find capital, whether it's, a lot of these platforms too, there's hundreds of them. And, I think one thing you should also maybe consider is if you're in a special lane that maybe you could look into grants. I think there's so many different avenues for people to look into and to find capital if they can't. And I think it's also really okay to ask for help. I think so many people out there, especially during COVID, there's so many communities of founders and there's so many, so I think it has evolved overall very optimistically, and whatever market corrections, happen or whatever type of economical situation we're in, it's always a good time to build a startup. And if you are a little bit further along, likely at that point you've raised capital already, and then you're much more better position to take on debt and or raise a larger round in a more traditional venture fashion. So I think all good things, and like I said, if you're having trouble and struggling and not willing to pivot in certain areas, consider working on something else or winding down and pivoting to something that you're really truly passionate about to find a way, because if you want to, you will. And yeah, I think that's pretty much my sentiments.
Cool. Yeah, I think great points there, right? Definitely, I think startups sometimes underestimate their own abilities to generate revenue, right? Instead of kind of trying to take care of the MVP, if you go out, get some paying clients, that might kind of get you a little bit further than trying to fundraise over a really kind of extended period of time, and also take time and resource away from just building the business, right? So I think that's something definitely that startups can consider as well. I think we are definitely seeing a lot of different kinds of companies as well, getting onto the Fundnel platform, raising funds through us. Yeah, so if I can put a cheeky plug here, if anyone wants to raise funds with us and explore that, please go to our Raise Capital page and check us out. Okay, so let's go on to our Q&A section. There's one question here that says, that's about valuation, right? Should valuations be done and kind of set before talking about financing? Who pays for the valuation fees? Are these even important, right? Especially when it comes to debt. So I don't know, Mahesh, if you have any experience with this. Do you find that valuation is something that lenders kind of ask you about? Has that been really important in your conversations as you raise financing?
From a debt financing perspective, no one has asked us, how do you value the company so far? But of course, they do look at the historicals. When you attach a warrant or options right to as part of the debt pricing or a right to investment, of course, they make their own assessment of what the valuations could be. So they also add it up to see how to increase the IRR, which is natural. They're in their business, so that's their business to do that. So before you are stable, you should not spend anything on valuation cost. Controlling cost is extremely important for a startup, early stage company. Every cent you spend, you have to look at whether it is being spent to have a P&L impact. So you may spend a $20,000 on getting a valuation report, but it is better to pay a 1 percentage point extra as debt cost, but save that cost. So it's all about weighing the whole thing. Right? Debt providers asking for warrants, etc., those structured deals. Again, going back to my original point, don't look at the cost, look at what is it for you, what's the value that cash is worth. For a startup, early stage companies or entrepreneurial journey, it's not about what cash costs. $100 is not $100. For an entrepreneur, $100 can be $1,000. That's the value of that cash. So it's interrelated. But so far, fortunately, no one asked me the valuation of the company. But yes, I did have some debt which has warrants attached to it. Of course, yes. So when I look at the IPO price and the guys who got the warrants, they're going to push up the IRR pretty nicely.
Absolutely, absolutely. Yeah, and I think it also is probably important to mention that for the most part, especially equity investors, they would want to do their own valuations.
Yeah.
They're probably not going to take your word for it necessarily. They might take the third-party report as a reference point, but I think they're going to kind of want to make their own sort of take how much they think, right, your company is worth.
And they do ask for cash projections for the future, and that's how they would work out your warrant structure.
Mm-hmm.
So the warrant structures is just pushes up the IRR a few reasonably, but it's worth it. You are sharing the value created, so there's nothing wrong.
Great, thanks, Mahesh. Okay, so it's a question for Zhiyi. What are your rates for unsecured business loans? Are these loans bullet loans? I don't know if you can give a quote on a webinar, Zhiyi.
Yeah,
but if you just want to talk a little bit about what kind of loans you guys offer, maybe that'll be helpful.
Okay, I think I'm happy to share the rates in the spirit of transparency, right? So our rates range from 12 to 18% per annum. So the range is decided by the risk profile of the customer. But that said, one thing that we are flexible with is you only pay for the time that you use, right? So if we're not going to say, you've only used it for 10 months, you're going to charge you for the additional 2 months. That's not going to happen, right? In terms of the types of loans that we have, so because we try to tailor our loans to your business, so you name it, we have it, right? So bullet loans, yeah, we do. Term loans, monthly repayments, we do. Factoring, we do. Purchase financing, we also do. But also bear in mind that we tailor the financial product very closely to your business. So it's basically a mirror image. So that what we don't want is for you to have to pay us when you don't have the money to pay us, right? Because it's not fair to the business and it doesn't do the business, like basically doesn't do the business justice, and it also doesn't help us at all. So therefore, we try and mirror it all the time.
Got it. Thanks for that, Zhiyi. Okay, there's a question for Giulianna about any experiences you might have had around companies in the financial algorithm space in fintech. Have you seen any of those come up? I think, that's probably getting more and more interesting. So happy to hear your thoughts on that.
Yeah, so actually my background's fintech, and I used to work at a large robo-advisory out of Hong Kong as well. And I think the fintech algorithm space is very trendy. And even those that, I think there's a saying where it was in the gold rush, instead of rushing to get the gold, then provide the shovels. And now I think what we're seeing is a lot of the sort of the providers are starting to also sort of get in and do different aspects. And was the question related to valuation? Yes, that's the question.
Yeah.
So I think in terms of valuing these companies, as well as any companies in the fintech space, I think those are all very, very specific towards the company. Depending on what they're specifically building, if it's trading, if it's whatever it is and whatever it looks like. I think for the most part, the valuations again depend on growth. The larger the value, usually either the higher the revenue or the higher the growth and or base of the company. I think specific to B2C or B2B, you typically find the well, it depends, because for example, Stripe is, one of the largest, valued fintech companies, but as well as other B2B companies. So this is a very broad question. But I think for the most part, if it's done well, it's valued high. And if it's not, then it's valued pretty low.
Cool. Thanks for sharing it, Giulianna. Okay, I think we have time for one more question. And I think this is a pretty interesting one. I think, all the panelists, please feel free to weigh in. The question is this: some VCs dislike crowdfunding and pure financial investors. What's your view?
I'll go ahead and start with this one. So I think the relation to crowdfunding, for example, one of the first companies that we were able to successfully find another investor through our syndicate was actually a crowdfunded company. And I think what crowdfunding does for startups, more than anything, specifically if it's a B2C company, is that it provides validation very early on. And so for a lot of times when you are struggling to, post revenue numbers or post users, if you have those pre-orders, or if you have those in any other traditional sense of validation, then I don't think it's necessarily a problem as long as the cap table is fairly clean. I think it's an interesting, and I think it's it's seen a lot more prevalently these days. I think those companies that do start crowdfunding, though, historically stick to crowdfunding. It's very rare that I come into companies that have crowdfunded, and it's usually sort of an alternative funding mechanism. So I think in those that get into it and do really well, they're really good on sort of, the entire package of the videos and the pitch and everything that's consumer facing. And they usually have a large base to help support them and start generating revenue. So I don't think it's necessarily a negative unless the cap table is an absolute disaster. Then that's true, I think, for any equity investor anywhere.
Great. Yeah, I think that's a great point. Yeah, anything to add from what you've experienced, Mahesh, or anything you've seen, Zhiyi?
I think crowdfunding is definitely a very good new source of funding. When we started, it was not too popular, but definitely it makes, crowdfunding is nothing but in the 70s, 80s, we had the cooperative system of managing enterprises, where the whole village, the modern version of that is what crowdfunding is all about. So it has history to it. Several centuries back, crowdfunding was in place in the world in trading. Whether VCs like crowdfunding or not, for a startup, for an early stage entrepreneur, take what you get first. Don't be too worried about whether subsequently a VC fund will like it or not. Just don't bother about it. That's what I would say.
Great. Yeah, I think it goes back to conviction, right?
Yeah, absolutely.
I think for me, it doesn't matter. It's really how you use the funds, right? So like Giulianna said, it's a testament to your business.
Exactly.
And again, like what Mahesh said, if you take $100 today, you grow it to become $1,000. I think to me, it's a testament to how you run your business. So I wouldn't say like VCs would dislike crowdfunding or pure financial investors.
Got it. Great. Okay. I think, we've reached the end of our time together. So I really appreciate everyone taking time out, all the participants as well. And I do apologize we weren't able to get to all of the questions. But I know in there are a couple of people who want to reach out to Zhiyi at Lyte and are interested in also reaching out to Giulianna on Draper Startup House. So I think when we send out the recap and the link to the recording, we'll also include some information about how you can reach out to Lyte and Draper Startup House and how they can both be helpful. Okay. So thank you so much to Giulianna, Mahesh, and Zhiyi for your time and all of your invaluable insights, our audience for your great questions. Thank you so much for taking the time out today. And yeah, as mentioned, a copy of this recording will be up on our blog. So we'll reach out to share that with you in the coming days. And lastly, if you'd like to keep abreast of what Fundnel is up to, do follow us on LinkedIn at Fundnel, and we'd love to keep in touch and hopefully meet you in person very soon. Thank you all, and we hope to see you at our next event. Thank you so much.
Thank you so much.
you.
Bye.
Nice meeting you. Hi, guys. Pleasure.